Hi there, and welcome to another insurance video. I'm Rebecca, your insurance lady, and in this video, I'm going to review reinsurance. I'll talk about what reinsurance is, why insurers reinsure, and the different ways reinsurance can be written. So let's get started. So what is reinsurance? This is a form of insurance between two insurers. Sometimes when an insurer has taken on a lot of risk, they'll want to make sure that they are insured so that the insurance company does not suffer a major loss when paying out significantly high claims. In order for an insurance company to protect their company from suffering a major financial loss, they would purchase an insurance policy from a reinsurance company. So reinsurance does just what it says. It reinsures an insurance company. So why reinsure? Most insurers purchase a reinsurance policy so that they can reduce the risk of catastrophic losses. For example, let's look at fires. If you were an insurer and you insured homes in a particular area, like near forest or brush fire areas, you would probably want to get reinsured for these risks. So imagine you had provided insurance for 20 homes in the same area. Let's say that the rebuild value or the replacement cost for those homes average about $400,000 per home. Now, let's assume that the average premium that the customers are paying for insurance is $4,000 a year per home. And this is probably on the higher end. In the first year, you should have collected $80,000 of premium. Now, I'm not even incorporating any small claims that might have occurred or anything that the insurer may have paid out. If there was an incident such as a brush fire that ended up in a total loss on even half of those homes, your insurance company still would not have made enough premium to cover those losses. This is one of the major reasons that an insurer would reinsure. So reinsurance can be written on an excess loss basis, a quota share basis, and a facultative basis. If it's written on an excess loss basis, the reinsurer will only pay the portion of the loss that exceeds the threshold. So the two companies can decide on the threshold. For example, the companies can agree to reinsure the insurer for anything that exceeds the loss of $400,000, just throwing something out there. They can share the risk of the loss greater than $400,000 because the threshold was $400,000. Make sense? So anything below $400,000 would be the responsibility of the insurer, the first insurer. Anything above $400,000 would be filed as a claim to the reinsurance company. A quota share basis just means that the insurer or the reinsurer will share the risk based on a pro rata or a fixed percentage basis. In other words, the reinsurer will only pay for a percentage of your losses. The facultative basis is when an insurer will elect to insure some risks but not others. So it is selective. So just to recap, a reinsurance is a form of insurance between two insurers. It is meant to reduce the risk of catastrophic losses, and it can be written on an excess loss, a fixed percentage, or facultative basis. So I do want to thank you again for viewing this video. Remember to hit like and subscribe because I'm working on more videos. I also have a couple longer ones on my web page, so if you like my style, support my page, feel free to send me an email. Let me know what you'd like to see or you'd like me to cover. This is actually a request from one of my viewers. So I am listening. So for those of you out there looking for some affordable study material, I am partnered with Kaplan Financial Education. Please use the link below and get a discount on any of their products. They do have full-on courses that will help you pass your exam. There's also a test bank with lots of relevant questions. You could either purchase a package or you can just purchase separately, little products separately. So just click on the link, select your state, and review the products. Thank you again for watching. I am Rebecca, and I am your insurance lady.